Without further delay, I'm really pleased to hand over to Jeremy Dibb, Director of Corporate Development and Investor Relations at Kenmare. Jeremy, over to you.
Thanks, Alex, and thanks to Yellowstone Advisory for the opportunity to speak to you all, and thanks to everyone for dialing in and giving us your valuable time. As Alex mentioned, my name's Jeremy Dibb. I've been with Kenmare Resources now for 6 years, and prior to that, I was a equity research analyst covering the mining sector at Macquarie and Canaccord Genuity. And on this opening slide, you can see here one of our mining ponds. Kenmare is quite unusual in the way that we mine, and we've got a dredge mining operation. And so on here you can see two dredges mining the front of that face and pumping the sand and water slurry onto the wet concentrator plant behind it before that slurry is then pumped through the wet concentrator plant. The sand is pumped to the back of the pond, and the heavy mineral concentrate is pumped to our mineral separation plant, where it's separated out into the final product. So hopefully that gives everyone a bit of a flavour of what we're doing. Moving to the next slide, I'll leave you to read the disclaimer in your own time. And onto the slide 3 as an overview of Kenmare. We are the world's largest supplier of traded ilmenite. And many of you may not have heard of ilmenite before. Ilmenite is a TiO2 feedstock, and TiO2 is mainly used in the production of paints, pigments and plastics. So it's what makes things white. The company is listed on the main board of the LSE, and we're also listed on Dublin Euronext. Our principal asset is the Moma Titanium Minerals mine, which is located in the north of Mozambique, in Southeast Africa. The mine actually began operating in 2007 and has been in commercial production since 2009. And unlike many mining operations, it has a very long life. We're expected to mine our existing resources for in excess of 100 years. And we're quite a significant employer in the country. We have over 1,400 employees in a rather remote area of Mozambique. And we represent approximately 5% of exports for 2018. We currently supply about 7% of global production of titanium minerals, and we expect that to grow to 10% from 2021 onwards, post the move of WCP B. Mining is a capital-intensive business, and to date we've invested $1.3 billion to develop the mine to its current position. And as at the end of March, we had net debt of $10 million with $100 million of cash in the bank and $110 million of debt. So I appreciate that some of you are existing shareholders and some aren't currently. So to give you a bit of a background on the commodity that we produce, mineral sands are used to cover all of the different commodities that we produce, and they're essential to everyday modern life, and you'll find them all around you. There are really two core product streams: titanium minerals and zircon. The titanium minerals represent the bulk of our revenues, being about 2/3, and 90% of that demand comes from the production of titanium pigment, which, as I've mentioned, is used in the production of paints, paper and plastics. It has what's called a refractive index that's second only to diamonds, and that's really to say that it bounces the light back well, which is what makes it a good bright white pigment. It also provides covering power. So if you have a blue room and you want to turn it yellow, to not end up with green, you basically need TiO2. It provides that barrier between the two colors. It's also inert. It's not poisonous like lead would previously have been used in paint. And you don't recover the TiO2 from your walls, and therefore there is a constant element of consumption that's required. There are really no substitutes for TiO2 within paints, paper and plastics. Companies will try and use polymers and fillers and other things in their paint mixture, but really that lowers the quality of the paint. So the paint quality is really determined in many ways by the amount of TiO2 in it. And the TiO2 also provides a UV protection. So if you have a low level of TiO2 in your paint, it tends to turn yellow over time. There's also 5% used in welding applications, particularly in ship fabrication, and 5% is used in titanium metals for planes, golf clubs, high-end cycling equipment, etc. Zircon is very similar. That provides the balance of our revenues effectively, so approximately a third. And it's mainly used in the ceramic sector. It provides many of the same qualities as ilmenite or rutile, the titanium minerals, in that it imparts whiteness and opacity to the products that are produced. But the zircon also provides strength and shock resistance and high temperature resistance with what's called a low thermal coefficient of expansion, which basically just means it doesn't change shape at high temperatures. And so it's very valuable in the high precision casting and foundry applications. And so for these reasons and the end products they go into, which are shown on the right-hand side of the slide, we refer to our minerals as quality of life minerals, because typically as people become more wealthy and GDP per capita increases, they tend to consume more of these types of products. So looking more now at the sort of supply-demand dynamics, whenever I'm looking at a commodity, there are three things I really like to try and understand. One is the supply, one is the demand, and the third is the level of inventory that's being carried. So from the period of 2010 through to 2012, we saw very high prices. Current prices for ilmenite are approximately $200 a ton, and you can see that they've risen substantially from 2016 when the market bottomed about $100 a ton on the right-hand side chart. From 10 to 12, the market became oversupplied, and that was principally as a result of Chinese iron ore production going up a lot. And that iron ore production in a specific area of China creates about 25% of the global supply of ilmenite, and that led to an oversupplied market. And that's why in the chart on the left-hand side, sorry, you can see the grey line, which is supply, is above the demand level, which was orange, and that built inventories, and that led to a declining price from 2012 through to 2016. And you can see from 2016 onwards, that white element is the consumption of inventories, which is shown as the grey above the line and the orange. And therefore, as inventories have become lower and supply has leveled off and demand has grown, those inventories have been consumed and prices have come up. What's important now for the industry looking forwards is, whilst GDP demand may be lower than people were expecting perhaps 5 or 6 months ago, there's also been a requirement for new supply to come online, because mining is a depletive industry and therefore it requires constant mines to be developed over time. And I think that that balance is what's uncertain. So in the longer term and medium term, we feel that very strongly that new supply will be required and higher prices will be required to develop those assets. But obviously in the short term, there is some level of uncertainty as to where that supply-demand balances out. In Q1 2020, we saw very strong prices. They were up for a fourth consecutive quarter. And so far prices have been resilient, but who's to know what happens down the line. Talking briefly on slide 6 about what we actually do, as I referred to at the beginning of the presentation, Moma is a very large mine with 100 years life of mine, and the current mine plan at our expanded 1.2 million tons of capacity runs beyond 2020. We mine mainly with dredge mining, also some dry mining near the dredging location, which provides additional flexibility for us to mine higher small grade pockets around the mine, which we wouldn't be able to access with the large dredging equipment. That material is then pumped onto this wet concentrator plant, which is point 2. And that was what you could see behind the dredges in the photograph on the first page. And as the sand and water slurry is pumped onto the wet concentrator plant, it falls over a number of spirals. And those spirals separate out the light silica sand, which as they fall out on the spiral tend towards the edge of the spiral, and the heavy titanium minerals are concentrated around the central axis of the spiral. We then separate off that heavy mineral stream. We rehabilitate the dune, and we produce the heavy mineral concentrate, which is a mixture of our ilmenite, zircon, rutile, and other products. Those products are then processed in the mineral separation plant, which is shown here as points 5 and 6, where we use physical separation properties. So some of the materials are magnetic, Some of them have different specific gravities, and some of them are more or less conductive of electricity. And using those physical properties, we separate them out into rutile, zircon, and ilmenite, which are stored in our product warehouse. And from that warehouse, we have a conveyor that runs directly onto our jetty, where we're able to discharge product onto our transshipment vessels, and then offshore, as we are right on the coast, we can then use the transshipment vessel to load our customer vessels. So it's a very well self-contained operation. We benefit from not needing to use any chemicals whatsoever. And because of the way that we mine at the beginning of the pond and then pump material to the back of the pond, it's called progressive rehabilitation. So we don't have huge remediation costs that are expected at the end of the life of mine. We're doing that as we go, which means we can hand the land directly back to the farmers and then continue to move the mine forwards. We also benefit from having hydroelectric power source, which represents about 90% of our power demand. And that's obviously very favourable, both from an environmental impact, but also relatively low cost. With regards to COVID, there have been no cases at the mine or in the communities surrounding us, fortunately. We are in a very remote location, which can provide challenges, but also advantages. We have been very stringent in our risk mitigation. We've restricted access to site. We want to make sure that our communities are protected. We've implemented social distancing measures and upgraded our health protocols, and also provided additional medical equipment to the site, and also try to help our local community where we can by providing sanitation kits and thermometers, and also ordered ventilation equipment to be used in the largest urban area of Nampula. We also have a non-for-profit organisation called Kenmare, which I'll talk to later, and they've been helping with education along with a local radio station to help disseminate information in the area. With regards to the markets, our production has risen in Q2 as we'd expected and guided, but the outlook remains slightly unclear. We've continued to produce and we've continued to ship products through this period, but there is a risk that the government restrictions that have been in place in Mozambique and South Africa will have some level of impact. We have a big project this year, which is the move of WCP B, and that's expected to happen in the third quarter, or had been planned to happen in the third quarter of this year. The challenge is that it's difficult to move people from Mozambique to South Africa and vice versa, and also challenging to move goods. And for the movement of B, we need both of those things to happen. We think we've got some good mitigation plans, but as a result of the potential impact, we have suspended guidance for 2020 at the moment. I've already briefly touched on the market, but our view is that whilst the market has been strong in Q1, it's unknown what will happen through the rest of the year. However, the offtake agreements for our ilmenite, which represents the bulk of our production, has been secured for the whole of 2020. And so we think that we're approaching it from a good position. We're very much focused on trying to keep our operations running as safely as possible. And we've been working with contractors and staff to make sure that whilst the business continues to run, it's done so in a safe manner. One of those key focuses has been on access to critical spares and making sure that the mine has enough given our remote location. So moving through into sustainability on slide 9, sustainability is core to our company, and the 100-year life of mine gives us our ability to invest in the long-term benefits of our workforce, the local community and the mine. Last year we established a board-level sustainability committee, and that's been a real step forward in providing focus to things that we were in many ways already doing, but has been a good step forwards for us. The safety record for Kenmare is very good in compared with the mining industry, but of course there's always more to be done. We're very proud to have our 5-star rated NOSA audit, which refers to the safety systems and processes that we run on site. Malaria is a big issue in the area, and we've seen a 30% reduction in malaria cases over the last 4 years. And not only does that help to increase the number of man hours, but also means that the local community is generally healthier. As I referred to with environmental impacts, we rehabilitate as we go, which is very beneficial. And because of the way that we deposit the sand back after mining it, we concentrate the slimes level just before we put the topsoil back, and that allows the soil to retain more water, which actually helps the agricultural value of the land when it's passed back. It also means that when we do that, we plant a lot of casuarina trees, and over the last 3 years, we planted more than 90,000 to ensure that the biodiversity is maintained in the areas which we've mined. We're also very proud that of our 1,400 employees, over 96% of them are Mozambican or were Mozambican at the end of 2019. We don't plan to increase that significantly beyond that, because we see there are some benefits to having diversification of skill sets and ensuring that we have the best skills available to the mine. But what we are now focusing on is ensuring that those Mozambican staff are upskilled as much as possible so that they can take on all roles within the company. As I mentioned briefly before, KMAD is a non-for-profit organisation which was established by Kenmare in 2004, and it's responsible for many of the community initiatives that the company has in the areas surrounding the mine. All of those initiatives are really focused on 3 areas of livelihoods and economic development, healthcare development, and educational development. There's a very good annual report for KMAD, which is available separately to Kenmare on our normal annual report, available on the sustainability section of the website. There's over 40 businesses that support it, and there are a range of different activities such as construction of schools, the provision of an ambulance recently, but also technical schools for vocational development, which helps to upskill the local Mozambican workforce and allows them to be in a position of strength when applying for roles at the mine. So what does this all mean for our business? Over the last 5 years, we have been trending at a rate of around 1 million tonnes per annum of production. And we're moving towards 1.2 million tonnes of ilmenite plus associated byproducts post the move of WCP B, which would be about 1.3 million tonnes of shipments all in. Our sales price was $248 a tonne in 2019. That's the received price to us, benefiting since the prices bottomed in 2016. Those steady shipments and increased prices have led through to us increasing our revenue substantially to $271 million in 2019. And there's been a commensurate increase in EBITDA volumes, which have been steady at about $93 million per year over the last couple of years. We're very fortunate to bring in a dividend this year. So in respect of 2019, we paid out a full year dividend of 8 cents per share. And at the end of last year, we put in new debt facilities of $150 million. Both the dividend and the debt I'll come back to on a following slide. We've also been advancing some growth projects to reach that 1.2 million tonnes of production. In 2018, we increased the ability of WCP B to mine. So currently there are 2 mining ponds, WCP B and WCP A. WCP A is 3,250 tonnes per hour and WCP B is 2,400 tonnes per hour. Then in 2019, we added a 3rd mining pond, WCP C. That has now begun production, and that has a rate of 500 tonnes per hour. So much smaller than the first 2, but it's able to mine smaller areas with very high grade. So it provides a substantial benefit to the overall operation. And then finally, we have the move of WCP B, which is the third and final of our growth projects in order to reach 1.2 million tonnes per annum. And as I said, that was due to happen in Q3 of this year. And I'll go into some more detail on the following slides. So what are we trying to do here? This shows our production over time, and it shows our cost per tonne. So as we are currently mining in the area of Namalope, we're progressing towards the end of that life of deposit. And so we're moving B in order to access higher grade material, which means that for the same costs, our production will increase as a result of those higher grades being mined. So in 2021 here, you can see that step up to about 1.3 million tonnes per annum. As I said, we've suspended guidance for 2020 and we'll look forward to updating that as soon as possible once we can better assess the full impacts of COVID-19. But what you can see here is that fall off in 2021 happens as a result of the higher production levels. And to relate this back to an ilmenite cost, you can see here the orange line, which trends to about $80 a tonne all-in cost of producing ilmenite in 2019, after taking into account the benefits of the rutile and the zircon that we produce. So if the ilmenite price is $180 a tonne, which was about the average in 2019, taking away the $80 a tonne cost gives you $100 a tonne margin, which based on last year's $93 million EBITDA on just less than 1 million tonnes of production, shows you the broad mathematic economics of operating the business. As we step out into 2021 and we see the fall in costs, we should also see that orange line fall as well as revenues go up because of the growth in the green bar. So those two elements together should lead to a margin expansion as well as an increase in overall revenues. The move of WCP B, as I've already referred to, is to help access some of the highest grades within the Moma portfolio at Pilivili, and they'll be delivered over an 8-year life of mine. This is the final step to us boosting production to 1.2 million tonnes, and whilst there's an 8-year life of mine, there are also adjacent deposits which we can mine into. At the moment, we've completed about 40% of the work and we've made good progress with the construction of the road. If you have a look on our YouTube channel or our social media, there's a good video that gives you an overview of the move and how that will happen. It's about 20 kilometers away from our existing mining location, and the plant will be loaded and transported via the 20-kilometer road that we are currently constructing. WCP A is also expected to move, but not until 2025 or 2026. And from that point onwards, neither WCP A or B are expected to move again within their economic lives. The capital cost for moving B is estimated at $106 million and will take approximately 12 weeks. This was scheduled to take place in Q3, but given the restrictions in place, at the moment, we haven't revised our guidance on when that move may happen, but we're working to mitigate any of the impacts of the COVID situation. So coming back to our financing, Kenmare's in a very strong financial position. At the end of the year, we negotiated new debt facilities. The debt facilities that we previously had were provided by development finance institutions, and that was done almost back in 2002. So these new facilities provide very attractive rates of loans. We are paying 5.4% plus LIBOR for the term loan, and that compares to Mozambican country yields, which are currently in excess of 10%. Given the uncertainties currently placed, as many companies have done, we've drawn on those debt facilities, which left us with cash of $102 million at the end of March and debt of $111 million. That doesn't take into account the fact we've also drawn on our revolving credit facilities of $40 million. So with all of those facilities in place post the end of March, we feel that we have a very strong balance sheet in order to be able to fund the development project and move of B in addition to our dividend. So our dividend policy that was put in place in October 2018 is to pay a minimum of 20% of profit after tax. We declared a maiden interim dividend in October 2019 and have subsequently made that payment. And the final dividend for 2019 was paid of 5.52 cents per share, approved at the AGM and actually due to be paid to shareholders tomorrow. We expect that as we move forwards and the capital development program of WCP B rolls off, it will give us more free cash flow and the ability to make higher shareholder returns going forwards, in addition to the fact that our free cash flow is expected to increase due to that revenue increase and the margin expansion that we expect to come through. Now, that may come in the form of special dividends or share buybacks, depending on market conditions at the time. So looking at us as a business and our strategy, what is it that we've been trying to achieve? Well, really, it's to become a first quartile margin producer. If you looked at Kenmare back in 2013, you can see that here we're a fourth quartile producer. Now, often mining companies will produce a cost curve where you want to be the lowest cost producer. But the way we think about things is really on a margin basis, because in our industry, different mines have different mineral assemblages. So if you think about the zircon price, it could be $1,200 a ton, whereas an ilmenite price might be $200 a ton. So the grade of the deposit and the relative assemblages could all be different. So in order to make things equal, we look at the revenues and divide them by the costs. So on this sort of a curve, you want to have as high a revenue to cash cost multiple as possible. If you're less than 1, you're losing money. And if you're at 2 times, it means your revenues are double your costs. So the first part of the curve that we can see here are really producers, those Chinese producers that we've talked about that produce ilmenite as a byproduct of the iron ore mining. So effectively, they're getting the ilmenite for free. They've just got the cost of processing that ilmenite into a final product. Beyond that, you then get into typical mineral sands operations. There's a couple of important things here. One is our progression in terms of position from a fourth quartile to a first quartile producer, which should mean that we can make money through the cycle, but also the steepening of the curve. And so because that orange line is steepening in comparison to the much flatter green line from 2013, it means that those at the bottom of the curve will be losing more money in any downturn, and therefore are more likely to shut down operations, reduce supply, and therefore help support prices before Kenmare would have to shut down. And that should mean that we're able to make money through the cycle. So to sum it all up, there's 3 things really with our investment case, or 3 strategic pillars as we like to refer to them. We've got 35% growth target from our 2019 production, driven by the move of WCP B to the new mining area later this year. We currently have an EBITDA margin of 36%, but we're expecting that to grow. And that will grow because the additional volumes we produce will be spread over a cost base that will not expand as much, and therefore our margins will go up. And finally, that allows us to generate more free cash flow, and we've already delivered on our 20% profit after tax dividend policy, and with additional cash flows we expect to be able to increase that percentage as the ability or need for the mine to spend money on capital programs reduces and we hit our 1.2 million tonne per annum target. So that's really everything. The Kenmare has a social media following, and if you're not following us already, please do so. We're on Facebook, LinkedIn, and Twitter, and we provide regular updates to keep people in touch. So please follow us if you don't. And with that, Alex, back to you.
Thank you very much, Jeremy, for a great introduction to Kenmare. I mean, the business really has been transformed over the last couple of years and looks like it's in great shape now. Also sounds like KMAD is doing some great work in the community too. So, well done for all of that. We've received a number of questions ahead of the presentation, and a number have come in during the presentation. And just as a reminder, if you'd like to ask a question, please type it into the Q&A box, and we'll try and get round to answer them. So look, without any more delay, onto these questions, and I'll start off one just really on pricing, talking really about the global economy. And as the global economy slows down, have you experienced any downward pricing pressure on your production?
Sure. Okay, well, look, I'll take ilmenite first, and then maybe talk a little bit about zircon. So as we stated in our Q1 numbers, the market for ilmenite, which is our main product, remained very strong. As already mentioned, we've had 4 consecutive quarters of price increases. And whilst there's been some evidence of near-term disruption to demand, there's also been impacts to supply. And coming into this, there was a need for more material going forwards, and inventory in the supply chain was pretty low. So it's been well supported. The longer term supply demand outlook also looks good. And so in short, we haven't seen much disruption to price, but it's hard to know whether we will see some down the line. China has obviously restarted production of many of their mines and pigment plants, as they were probably further ahead in this crisis than some other parts of the world. And they're about 30% of our business. But it's hard to know what the implications might be down the line as construction slows, if that were to happen. From a zircon perspective, the market's been slightly weaker due to some oversupply in the market and a bit of a weakening in the Chinese property sector through the second half of 2019. At the moment, we think that those challenging conditions for zircon will probably persist in the short term, but they will improve in the medium term as there are some very major zircon producing mines that are approaching the end of their lives in the next couple of years, which we think will provide some support. The top 3 zircon producers account for probably 60 to 70% of global production. And so the price is really set by those 3 players.
Okay, great. Thanks for that. Someone's always been looking at your first quarter production and asked the question, why was the production a little bit weak in the first quarter?
Sure. No, look, production in Q1 was disappointed. We'd expected that ore grades would be lower than they were in 2019 as a result of moving towards the end of mining in that Namalope zone before moving WCP B to Pilivili. However, the excavated tons were below our anticipated level. It was primarily due to lower utilizations and throughputs. We brought forward 8 days of maintenance at our biggest plant, which is WCP A. And you know, within a quarter of 90 days, that's obviously 10% of your production time that's lost. However, that means it won't happen because it was brought forward in the following quarters. And WCP C was expected to contribute more. It was a new plant that I mentioned we brought on in 2019, but it didn't start production until February. So that was slightly late on delivery due to it being late from the contractor. And so utilizations and throughputs were expected to increase in Q2 and have done so, I'm pleased to say today.
Okay, thank you. A question, I guess, linked to this in terms of production and also focusing on the WCP B move. So on the production side, how will production be impacted if the move of WCP B is delayed? And then just on the risks to WCP B being finished on time, you know, what are the risks to WCP B being finished on time?
Sure. So there is additional lower grade ore that could be mined at Namalope for 2 to 3 months if we were delayed. However, you know, production for the year would be impacted if the move was delayed significantly due to the grade differential between what we have available to mine in the surrounding area versus the grades that would be available in Pilivili. You know, the value of this company really is in our ability to move to 1.2 million tons per annum, reduce those unit costs, and move WCP B successfully in order to be able to do that, as well as accessing the higher overall production volumes. So that's really the focus of our business, to make sure that we do that safely and at the right time, but as soon as possible. We've got some mitigation plans in place that I talked about, and we'd hope to be able to provide some update on guidance. But given our strong balance sheet, you know, we feel well resourced to be able to complete that move at the right time. The main elements with regards to move are the road construction, which is ongoing and has been progressing very well. There is the need for the positive displacement pumping to be put in place, and there is which is to transport the HMC to the mineral separation plant, so that concentrated material through to the mineral separation plant to produce the final products, and then electricity in the local area. So as long as the road is constructed, there are potential opportunities for us to either truck HMC or to use the temporary power sources potentially, if those two elements weren't completed on time. So once we've worked through those mitigation plans, we'll provide an updated guidance.
Brilliant, thank you. I think a number of people have picked up on the fact that this is going to be quite a cash generative company going forward. And so the inevitable questions asked about capital allocation and some questions about some share buyback. So can you talk a little bit about your approach to share buybacks and explain the rationale behind the company, and some comments that suggest it would be enormously accretive to buy back shares rather than pay dividends, and perhaps this might show a little bit more confidence in the future of the business. So perhaps you could comment on that, and then as a follow-up question on dividends, which I'll come on to.
Sure. Yeah, so look, the way that we established our policy was a minimum of 20% of profits, and that was to make sure that it's a steady number that people could look at and try and forecast and have some level of certainty. That's not to say that the 20% is a cap by any means. It really is a minimum. And then going forwards, we'll have to look at what the debt servicing requirements of the business are. Relatively muted in relation to the $1.3 billion that's been spent on the mine, with $110 million of net debt of gross debt at the end of March, and $10 million of net debt. And then, as you say, is the best way to return capital to increase that dividend percentage, or is it to do a share buyback? And in order to make that decision, we'll have to look at our absolute valuation and value of the business, and also to look at the relative valuations of the business. Obviously, today trading at broadly 3 times EV/EBITDA, I think there'd be a strong rationale for doing excess returns by way of a share buyback. But if we were trading on a stronger multiple, then perhaps a higher dividend would be the right way to go. So that's definitely something that we will be looking to focus on over the next 6 months as we finish that move of WCP B, and then outline our plans to market.
Okay, great, very clear. And on the dividend, are there any dividend remittance issues with Mozambique?
No, there's no dividend sort of withholding tax. The company pays corporation tax as any other company would in Mozambique. So we make our payments there, and then no, there's no sort of dividend withholding tax within Mozambique that causes any challenges.
Okay, thank you. Moving on to some new topics here. There's a question here, and I'm not familiar with this name, so apologies if I don't pronounce it correctly, but are there any troubles at Cabo Delgado? It's an evolving situation, but how might it impact Kenmare and their operations in Mozambique?
Sure. So Cabo Delgado is at the very north of the country. It's the province that borders Tanzania. And there has been some sort of Islamic linked insurgency in that area. Those areas are also the area where there is offshore oil and gas. So previously Anadarko, now Total, but also Eni are looking at the Rovuma basement, which is a investment in the next couple of decades, which will be in excess of $20 billion into that area. I think last week there was $4.5 billion loan provided to the government of Mozambique, funding part of that development. And so there's been some levels of unrest in that area. Now that area is probably 500 kilometers north of us, and as the crow flies, probably 800 kilometers or so by road. So it's quite a long way away, but it's certainly unsettling. The government does seem to be focusing more on it now, and there's been more active army engagement, but it's certainly something that we are looking at and focusing on to see if there is any move south.
Okay, thank you. Are there any substitutes to the main product, and are there any high cost producers that can quickly ramp up production as the cycle turns?
Yeah, good question. Look, there's not really any substitutes to TiO2, either sort of synthetic or natural. As I said, paint companies for years have been trying to use polymers and fillers and other things to reduce the amount of TiO2 that they need. But broadly speaking, the quality of paint goes down quite rapidly as you drop the level of TiO2, and so you start to get back to those. So if you remember, sort of in the 90s, when you'd paint your wall, and maybe 2 or 3 years later, suddenly it would start looking quite yellow. So you lose that UV protection. When you look at the sort of the cost of painting your room, particularly in Western economies, the majority of that cost is in the labour rather than the paint. And so it's a bit of a false economy. And I think that most companies in the construction space understand this, that if you spend less on your paint, it means you have to do it more often, and therefore there's a higher cost in doing that. So it's better to use a higher quality paint. So no real change there, and none that's foreseen. Sorry, what was the second part of the question with regards to products?
Well, could there be new producers? Could they?
Yeah, so there's not many mines that have been shut down. Most mines have typically been shut down because they've reached their end of the life of mine. If you look at the types of deposits we have, it's not really like a gold mine where you might suddenly find a very high grade mine, somewhere no one's previously explored. Now, that's not to say it couldn't possibly happen, but typically with the bulk tonnages that we're talking about that we mine, those mines are found generally in coastal locations and near surface. So we have almost no overburden. There's some topsoil, and then broadly we're straight into mineral. So those large areas, you can physically see the black sand on the beach. We don't actually mine the actual beach. It's sort of an inland beach, but you can see those minerals on the coast, with the naked eye. So what that means is that over time, the best deposits typically that have been brought on stream have already happened. And if you look back to 2010 and 12, when the last mines were developed, those mines were all found 20 to 30 years previously and weren't developed because the economics weren't compelling enough. But as prices rose during that period, suddenly those mines got funded and built. There are some mines in Indonesia that are sort of more mum and pop kind of, family operations that at very high prices can come on stream. And to be honest, that's good for an industry because it means it helps to dampen out really big spikes in pricing. So I think that that's beneficial. And there's some supply in India that's been closed down. And the reason that that's been closed is because there were some allegations of illegal mining. So sort of mining outside of concession areas, or actually, mining the beaches and causing erosion. So that's led to the government reducing production there and stopping it from anyone that isn't part of a government company effectively. So that's probably reduced 2 or 3% of global supply, but we don't see that coming back on anytime soon.
I guess a slightly linked question that's come in, and I guess picks up on your strong, ESG credentials. The question says, does the fact that you're so good on this environmental, social side, does that has an impact on the pricing that you can achieve for your products?
No, I mean, I'd like to say it does. It doesn't. We haven't seen that to date with people being focused on it. I think that in time, hopefully that might happen. But I think where it probably does give us a lot of advantages, and where we're certainly putting a lot more focus now, is that mining is often thought of a dirty industry, and I think in our case, there's a strong case to be made for the fact we're using hydroelectric power. We're not using any chemicals. We're actually handing the land back to the local community in a better condition than when we took it, and we're doing that over a relatively short period of time. So, 18 months to 24 months to hand the land back, rather than 20 or 30 years digging a deeper and deeper hole that needs more and more money spent on it. And there's a lot to do with the geology that just means that we're able to do that. But hopefully, by explaining that to investors and others, it should be well regarded and eventually result in a higher valuation multiple.
Great, thank you. A couple more questions on sort of capital allocation. One, what's the company attitude towards M&A, and would Kenmare consider acquiring its own fleet of vessels as part of a vertical integration move?
Okay, in terms of the vertical integration vessels, I think we're quite comfortable with our transshipment vessel approach. I don't think we'd want to get into anything. Shipping is a very, very big market, and I think we like to focus on where our skills lie. A lot of our customers are part of much larger groups, and they actually have their own vessels. So we prefer to sell as soon as our transshipment vessel discharges that material onto the customer vessel. It then becomes their material, and I think that's where we think the best benefits lie for the business. With regards to M&A, I think you've always got to keep everything under review, but because of the price of minerals now, whilst they're much stronger than they were in 2016, having gone from broadly $100 up to $200, they're still a long, long way away from what the peak in 2012 was, which was sort of $300 to $400 a ton for ilmenite. And so while they make good margins for us as a business with a market cap of $300 million, when you compare that to the capital investment of $1.3 billion, it's not quite as exciting. And so when you look at businesses out there that want to develop mines, we think it's going to have to happen. But in order for that to happen, prices are going to have to be at a level which are exciting for investors to make that capital investment. And at the moment, we don't think the prices support that happening. So definitely one to keep under consideration. But with 100 years life of mine, there's lots of opportunities for us internally, and it would have to take a very exciting project externally to compete with that.
Okay, very, very clear there. Could you talk a little bit about inventory regarding what you see regarding demand and how you're modelling pricing post this quarter? Obviously, that may be a bit difficult in the light of COVID-19, but any thoughts you could add on that would be appreciated.
Sure. So I think the difference in this downturn, when you compare to the industry downturn where prices went from $400 a ton down to $100 a ton in 2012 through to 16, this is a market where there's not really any financial manipulation. You don't have Chinese traders, trading all on copper inventories and locking them up. We're a bulk mineral that's expensive to store and difficult to store. So, at $100 a ton, you don't want to be storing lots of ilmenite. And so that downturn in that period was really to do with, as I said, that additional supply coming on from China with the result of iron ore. Iron ore prices, whilst they're very high now, aren't at the $160 a ton levels that they were back then. So I don't see further incentivization of more iron ore mines bringing on ilmenite. In fact, we're actually seeing that ilmenite trail off slightly as their grades come down in China, and therefore, with regards to prices, we see that in the longer term, as I talked about it already, new supply will be required, and that supply will require newer pricing. In terms of inventories, we came into this downturn or pandemic environment with very low inventories in the industry and with supply coming off and new supply needed. So this is really a demand-led downturn, if it is a downturn, or a demand-led challenge, whereas in the past it was very much supply, oversupply. And so when you're in an oversupplied market, things tend to trend towards, what people will continue to produce at before they shut down. Whereas, us being in a completely different position in the cost curve now, we see much more resilience in the cash flows of the business. But in terms of specific pricing, I can't give you any forecasts. I think that, it's undoubtedly going to cause some level of challenges if economic activity isn't as high as it was, but to some degree that will be offset by the lower inventories and production.
And we've got a couple more that have come in now. trading on circa 4 times forward earnings and with a strong balance sheet, the shares look good value. What do you think the market is missing?
Look, I think there's a couple of things, and I think that, I don't think mining is necessarily, the flavor of the month, the way that maybe a technology company might be. I think there's also an element that within mining, mineral sands is quite a niche product. And if you are a fund manager that's looking to, invest your time, you want to be able to leverage that into multiple opportunities. And, outside of Kenmare, Aluka and Base Resources, there's a company called Mineral Resource Commodities that's quite small. There's not many opportunities for you to be able to leverage your investment and your time to understand mineral sands in the same way as there is in those other commodities like iron ore or copper or gold, for example. And I think Kenmare isn't also of the size that it was previously. Back in 2012, Kenmare had a peak market capitalization of about 2.2 billion US dollars, whereas today at probably close to $300 million. That means that we're not in the FTSE 250, and perhaps not as widely followed as we may have been previously. Now, obviously, as we generate free cash flow, increase dividends, and those things, we'll start to screen under more investors' different metrics that they look for, but that tends to happen after the fact of delivering it. There's also obviously a level of risk with regards to the impact of COVID, as there is for many businesses out there, and the implications for the move of when WCP B happens. That move will cost about $106 million this year, and so whilst we have lots of cash available and we're generating free cash flow, I think post that move happening, there'll obviously be an increased level of interest in the business.
Great, thank you, Jeremy. Got one last question for you here. Do you hedge against commodity price fluctuations?
No, we don't hedge pricing at all. I think we believe that investors are buying into Kenmare Resources if they choose to do so, in order to access those commodity markets, and therefore we don't hedge. That's not to say we wouldn't ever, if we were doing a project and we saw it was a good opportunity to fund the development of that project as a result of hedging, I think we might look at it. But as a matter, we don't try and sort of game the markets and try and work out which way prices are going. What we try and do is produce our commodity as cheaply as possible and run our business as efficiently as possible, and hopefully be a first quartile producer. And then whatever happens to the market price, we'll make money through the cycle, and we can then return that to shareholders.
Thank you very much, Jeremy. That brings us to the end of today's webinar. So thank you, Jeremy, for an excellent presentation, and thank you to everyone for attending.